Hi all, it's Joe Duffy, and this video is a quick overview of options trading and how we use it, and particularly the spreads. Okay, what I have up here is a ladder of the S&P 500, which is an ETF that trades in the NYSE like a stock. So this stock for the S&P 500 is, follow my cursor, 296.28 right now, and the options ladder that you see down here has an expiry of November 1st, 2019, which is about 3 weeks ahead of where we are right now. It's going to cursor down so we put the strike price about the middle here. So if we were just buying a regular option, let's choose the 295, we pay $5.21 for that. What that means is we have a right to buy that option or buy this stock for $2.95 between now and November 1st, so about 3 weeks from now. Now, if we held it to November 1st, the stock would have to get to 295 plus 521 or 300.21 just to break even. Okay, now normally you don't hold options that long, but that's what it would have to get to intrinsically for you to break even. Now, if it got to 300, which is still a 3 and 72 point move, you would still lose actually 21 cents, because then the stock would be worth the difference between 295 and 300, which would be 5. Now, if it did that in the next week and there was still 2 weeks left in the option, then this option would probably be worth 6 or 7, and you would still making money on it. Now, if it went to 305, obviously now it has an intrinsic value of $10, so the option could be worth 10, 50, 11, depending how much time was left on it. Okay, so obviously the advantage is instead of paying $295 per share of stock, you can control that stock for $5.21, which is obviously a lot of leverage. So a small amount of money can make you a larger amount of money. Now, very clearly as well, the obvious disadvantage is that you're paying a time value for that privilege of leverage, and that time value decays every day. So what can we do to mitigate this? Well, there's a couple of ways, or more than a couple actually, but we use various types of spreads. And today what we're going to talk about, and I'm not going to suggest that this is the right spread for this moment in time, because there's always a strategy that's best, and they vary depending on market conditions. But just for my example, I'm going to show you the mechanics of a debit spread without suggesting that at this point in time it's the best strategy that might be employed. Okay, so let's say we buy this same 295 call at $5.21. We can then sell the $2.28 300 call against it. That means if you're long the 295, you can be short the 300 because you're protected. I mean, if the stock goes up to 305, this one's worth 10 and this one's worth 5 at expiry, so you're good. If the stock goes the other way and you hold them at expiry, they're both worth 0, so you're good. So now though, instead of investing 521, you get to invest the difference between 521 that you pay and the 228 here that you get back. So you're investing $2.93. Okay, so $2.93 is now your investment instead of $5.21. So basically less than 60% of your original investment now is at risk. Now that has a lot of advantages. If the market goes against you a little bit, this is going to protect you because it's going to go down at the same time as this is going down. Okay, so you can get out of the spread when you're wrong at much less damage usually than you can if you are just long the call straight out. In fact, all the time you can get out at less damage. Now, if the market goes up, let's say the market goes up to 300 by expiry. Well, you're short the 300 at expiry; it's worth 0. Okay, you're long this one. It's worth 5, so you put 293 in, and you're taking 5 out, so you made a profit of $2.70, a 60% gain on your capital there. Now, if it goes up to 305, the 295 is an intrinsic value of 10. the 300 has an intrinsic value of 5, so still you're making that same $5. So you are capped that you can only make or get back out $5. But in any option trade, if you're putting in, 293 and taking out 5, it's not a bad deal. So that's how option spreads work, again, in theory. Now, let me say that you can often get a better spread than the one that's showing right now in the S&P, and that's one of the things that we use different kinds of strategies for. Okay, sometimes this spread, which is a 293 today, may be 233 another week, depending on a lot of other conditions in the market. At 233, obviously, it's a much better deal than it is at 283. So, again, this isn't a recommendation that this is the best strategy for right now in the market. It is an example of how a bull call spread would work. Okay, so you can really mitigate your mistakes and still do well on your gains. And that's why we like the idea of spreading, basically, because it you give up a little, but we think you gain a lot. So this is a straight what's called a debit call spread. We'll do a couple other videos which are a little more sophisticated in terms of understanding them. If you haven't been familiar with options, you may have to watch this video a couple times to understand it. It's sort of like when you first started trading options. For me, at least, it was had to go through it a few times and a few examples before I understood it, and then, of course, it becomes second nature. Okay, so this is called a debit call spread. Okay, and it would be happening if I was bullish. Okay, we could do the exact same thing with puts, but you understand the principle is, buy the expensive one, sell one that's a little cheaper, and the difference between the two strike prices is the amount of money that you stand to make. All right, any questions? It's Joe at jdtradingsystems.com, joe at jdtradingsystems.com. Thanks for listening.